Hi friends, welcome to the 11th class accounting class, 11 commerce accounting class. Today we are going to discuss about the subdivision of journal. Subdivision of journal, why it is necessary? You see that business is recording the numerous transactions in the books of journal. So journal is the record of huge transactions. So sometimes the transactions are so heavy that it is not possible to record in one book, which is called the books of prime entry or the books of original entry. That's why, to avoid the huge records, numerous transactions, the accounting makes it simplification of the journal. So simplification of the journal is nothing but the subdivision of journal. That this subdivision of journal is necessary to divide the journals into the different book, so that the transactions are recorded in the different book, and the journal book will be very less in number of transactions to record. So to make it very simplification and the easy process, the recording of transactions is not like the journal transactions, but it is done in a separate manners. See, so this subdivision of journal or the classification of journal is mainly done into two categories, that is subsidiary books and journal proper or general journal. Journal proper or the general journal is the same as the recording of journal entries in the books of journal. But the subsidiary books is the subdivision of journals, the part of subdivision of journals, that the subsidiary books constitutes of your two books, mainly that is a cash book and non-cash book. Why cash book and non-cash book? Why not other books? Because the business deals with a number of transactions every day related to the cash transactions, cash receipts, cash payments, etc. So those cash receipts, cash payments transactions, if it is separated, then certainly your half of the journal transaction is reduced. And then non-cash book consists of the purchase of the goods related transactions, that is the trading, buying and selling of goods and services, like purchase book, sales book, return inward book, return outward books, bills receivable book and bills payable book. So this is to be subdivided so that the journal transaction is reduced to small extent. Because the business deals with the numerous transactions, everyday business deals with the cash transactions and the purchase of goods and sale of goods. So if these transactions are to be separated from the journal entries and rest are done in the journal form, then certainly the journal book is to be very simplified, easy to handle, to record the transactions in a simplified process. Let's come to the subsidiary books. Subsidiary books is also called the special purpose book. Why special purpose book? Because these are the special transactions. Business mostly deals with those transactions in everyday. The everyday transactions are like cash transactions and goods related transactions. So if the subsidiary books is make it separated from the journal, then certainly your journal is to be reduced to less. The cash book, the subsidiary books is again divided into two categories, cash book, non-cash book. That means cash transaction is separated, non-cash transaction is separated. Cash book is again divided into two books, that is the main cash book and petty cash book. Main cash book means the cash transactions which are in larger amount, the big amount, that is called main cash book. And petty cash book means the book which records very small transactions, petty transactions, very small payments like postage, telegrams, telephones, stationaries, 5 rupees, 10 rupees, 20 rupees, 15 rupees, 11 rupees. This type of transaction is very petty transaction, 2 rupees, 50 rupees. And this type of petty transactions are separated from the main cash book, and main cash book records the larger transactions, little bit bigger transactions, 100 rupees, multiples of that, or the 50 rupees, 2000, 100, 1000, like this amount of the transactions, receipts and payments. And the main cash book is divided into 3 categories, that is single column cash book, double column cash book, triple column cash book. Single column cash book means only one column is there to record the transactions in the cash book, that is the receipts is having one column, payments is also having one column, so that it will be recorded all the transactions. Double column cash book, the 2 column is to be maintained. So in practice, that means in higher studies, when you go for the higher study, you will see there double column cash book means cash column separate and discount column is another column is added. So in single column cash book, the only cash column is to be maintained, that all the transactions are recorded there. No separate transaction is recorded for the discounts, because discount is not recorded in the main single column cash book. When we come to the practice of the higher studies, that is double column cash book, there we are maintaining 2 column, 1 column for the cash, other second column for the discount. So discount transaction is recorded there. But in 11th class courses of studies, it gives that double column cash book means cash column and bank column. The 2 column is to be maintained. So then third one is your triple column cash book. Though it is not in the course of 11th class accountancy, but in the practice in the higher studies, we study that triple column cash book means 3 column is to be maintained. 3 column means that is first is your cash column, second discount column, third that is bank column. So 3 column is transaction is to be maintained for the transaction separately to record cash transaction in the cash column, bank transaction in the bank column, and discount transactions in the discount column separately. So that is triple column cash book. So in 11th class, though it is not in the triple column cash book in the syllabus, so we are restricted to the single column cash book, means 1 column, that is the cash transactions. Second is your double column cash book, cash column and bank column transactions. So this is the cash book, main cash book. Then second is your petty cash book. Petty cash book records the small payments transactions, small amounts transactions, very petty day-to-day transactions happened in the business, that is to be recorded by the petty cash, recorded in the petty cash book separately. So the person in charge of the petty cash book is called petty cashier. There is a clerk who maintains the records, and main cash book is recorded by the head cashier. We call it is the accountants. So that is the head cashier maintains the cash book, main cash book. Petty cashier maintains the petty cash book, that is the clerk from cashier. So this is cash book. Then non-cash book, other than the cash transaction related to the goods, credit purchase of goods, credit sale of goods. Credit cash purchases, cash sales recorded in the cash book, but credit purchases of goods are recorded in a separate book, that is called purchase book. That means business deals with the purchase of goods. There is a lot of transaction happens. So when lot of transactions is there for the credit purchase of goods, we make it separate book, that is called purchase book. Likewise, credit sale of goods, cash sales recorded in the main cash book, but credit sale of goods recorded in the sales book. Separate book is maintained, that is called sales book, because business means buying and selling of goods and services. So buying and selling of goods, buying of goods, purchase book, selling of goods, sales book. That is only credit transaction is to be recorded. So likewise, the returns inward book, that means credit sale of goods returned back by the customers to the business. So that is return inward book, or the sales return book is maintained separate for the return inward transactions. Likewise, for the there is sales return, and this is purchase return. Return outward book means the book which maintains the records of goods returned by the business to the creditors. That means purchased goods and credit returned to the creditor. So that is the return outward book, maintains separate transactions. So this is bills receivable book, receiving the bills recorded in a separate book, that is bills receivable book. Payment of bills recorded in a separate book, that is called bills payable book. These two book is to be discussed separate in a chapter, that is called bills of exchange. Bills of exchange chapter. There is a separate chapter is there to be discussed. That is bills receivable book and bills payable book. So this subdivision of journal you might have understood that how it is simplified. Journal is divided and classified into different small books, and the journal book is to be simplified and the subsidiary book is to be maintained. So when we are maintaining the subsidiary book, it acts, the cash book acts as a journal as well as ledger. The cash book plays both the role, that journal as well as the ledger. Recording of transaction journal is not required, and the ledger account of the cash book is not to be maintained, because the cash book is same as ledger account. So direct the closing balance of the cash book transferred to the trial balance. So likewise, that non-cash book, purchase book, sales book, purchase return book, sales return book, bills receivable book, bills payable book, all those books are not separately recorded in the journal entries. That is recorded the transaction in the books, and from this book it is posted to the ledger account. From ledger account it is transferred to the trial balance for preparing final accounts. So this is non-cash book. Then come to the journal proper or the general journals. That means other than the subsidiary book, rest of the entries are recorded as usual in the journal format. That is called journal proper or general journal. So that means general journal, just like of the general recording of the transaction, the transactions are recorded in the journal format, because these transactions are not recorded in those books in the format. So that's why it is to be separated, and very few transactions are there. First, for example, opening entries. As you know, that is the business opens with the various assets, liabilities which are brought forward from the last year to the current year. At the beginning of the year, the entries prepared, that is called opening entries. That is assets account debited to liabilities account to capital account. Then closing entries, that means all the ledger accounts have to be closed and transfer the balances to the trial balance, and from trial balance to the trading profit loss account to prepare the final accounts. So for preparing final accounts, the entries which are to be transferred to the trading account or profit loss account is called closing entries, to close the books of accounts. And rectification of entries, any transaction or mistake or the wrong in the recording of the transactions, these are to be rectified. This is called rectification entries. And fourth is your transfer entries. That means from one account to the other account, transfers. Suppose X account has been credited and Y's account has been debited by 500 rupees. That means transfer of X account to the Y's account. So this is transfer entry. This is not recorded in the either of the cash book or non-cash book. So that is separate recorded in the transfer entries. Then adjusting entries like related to the outstanding expenses, outstanding incomes, prepaid expenses, prepaid income or the accrued on and income, then depreciation, likewise bad debts, all those transactions are called adjusting entries. These are to be adjusted at the last closing date of the accounting year. Then shares entries, these are related to the share issues transactions, that is separately discussed in the 12th standard syllabus, related to the issue of shares, issue of debentures, redemption of shares, etc. is there. Then miscellaneous entries, rest of the entries which are to be found occasionally to record the transaction related to purchase of fixed assets, sale of fixed assets on credit, not on cash. If it is cash, it is already recorded in the cash book. So only the credit sale of goods, credit sale of assets, credit purchase of assets, fixed assets are recorded in the miscellaneous entries. Any other entries related to that which are not recorded in the cash book and subsidiary books are recorded in the general journal or the journal proper format. So this is about the subdivision of journals.